definition on how financial asset is constructed is anything that helps you generate returns on a continuous basis and something that really does not require any kind of external pushes from time to time. So the returns have to be intrinsic, if that's the word that we can use. A lot of us know this as a basket of stocks. That's how the classical definition goes. And now, what is a stock? A stock is basically an ownership in a company. So when you buy a share of anything, you basically become an owner, a shareholder in the company. And by virtue of being a shareholder, it allows you to participate in the profits or the money earned by those companies. So what is behind those stocks? The underlying asset there are businesses, thriving businesses which are there, which have a profit motive. So I think this is what sometimes people kind of forget, that when you buy a mutual fund or when you buy a stock, you're not buying pieces of paper. What you're buying is flourishing businesses where you yourself are employed. These are the underlying assets, and if these businesses actually do well, your mutual funds also kind of does well. And it's the profit motive that again goes back to the shareholders in the form of returns, which is in the form of dividends as well as capital appreciation. So I think this is the basic thing that one needs to understand about mutual funds. People say equities are risky. Maybe it's risky, maybe it's not risky, but it becomes more like a generalized statement. I've heard a few more. For example, people say investing in stocks is like gambling. If I were to believe in this, then virtually every day there are lakhs and lakhs of people who are gambling, which is not the case. There are people who smartly look at stocks and are able to generate a lot of wealth for themselves. Another myth that comes across is only brokers make money. No. Mutual funds are not bought by brokers. Mutual funds are bought by people like you and me, and we make money out of these. And now this is a very good one. High risk means high returns. So it's more of a fallacy here, wherein people do think that high risk means high returns. And I think some of these are myths. Some of them might be true. Some of them are absolute myths. And it's very good to kind of understand these as your building blocks of investing. Understanding and having your goals defined is very useful. I think this should be step number one when it comes to building your portfolio. And that's why protecting the downside is probably one of the most important thing and the basics of kind of building a very long-term portfolio. Now, downside is nothing but kind of controlling and managing the risks that you have in any portfolio. One way in which people look at, when to invest, which was what the market conditions part was all about, is by looking at the price earning ratio. So what I've done is I've mapped the price earning ratio for the last 21 years actually. What is the price earning ratio? A price earning ratio simply says for 1 rupee of profit, what is the price you are ready to pay? So for example, 2020, if you look at it right now, it's at 38. So effectively what it means is, the Nifty 50 companies, if all put together do 1 rupee of profit, you are ready to pay 38 rupees for that chance of receiving that 1 rupee of profit. That's what the price earning ratio determines. Needless to say, lower the price earning ratio, the better it is, because these are buying opportunities and therefore it will really kind of lower the risk dramatically. It will also be the time when you will actually hear a lot of bad news. So for example, 2008, when there was a financial crisis, all you could hear is bad news of unemployment and banks getting, kind of bankrupt and all kinds of things happening, economic growth being down, etc. Similarly, 2011, 12, 13 was also similar. So you hear only bad news. And even March of 2020, you heard a lot of bad news. And that's when the investor participation actually goes down. So these are actually the biggest buying opportunities. When there is fear among people, that's probably the best buying opportunity. And when there is greed among people, that's probably the best selling opportunity. So that's something that can really help protect your downside more from an equity perspective. Very quickly, some top mistakes to avoid. One is to kind of avoid NFOs to the extent possible, for the simple reason that a new fund offering has absolutely no performance history, no rating, ranking, etc. We did a very interesting video on this on the ET Money YouTube channel also. So if you get some time, do watch that as well. But generally, you should avoid new fund offerings in general categories like large caps, multi caps, etc. If it comes in a very new category, you can still go for it, but generally stick to the established schemes because they already have a track record running into multiple years. The other big mistake to avoid is please go for direct plans. Avoid regular plans to the extent possible. That's because regular plans, regular mutual funds have the distributor commission which is baked into it, which is pretty high. It's about 0.7%, 0.8% of the returns. So if in a normal environment you're making about, let's say, 10% returns and you have to pay about 0.7, that's like 7% of the returns you're giving it to someone. I think another interesting way of looking at it is by simple math. So if you put in 10,000 rupees in SIP for 20 years, in a direct fund at 12%, you make a crore of rupees. But on a regular fund, which is at 11.3%, you make 90 lakh rupees. So this differential of 9.2 lakhs, guess where that 9.2 lakhs goes? That 9.2 lakhs is what you have paid from your pocket as distributor's commission. I really don't think, just for setting up an SIP that you're very diligently paying over 20 years, a distributor really warrants being paid a commission of 9.2 lakhs. So please avoid this as much as possible. So there are platforms like ET Money that offer these, and there are no additional costs for getting into direct funds. It's getting popular by the day, and if you have any regular plans, please look to move them towards direct plans. The third learning, again very important, is not to react to short-term fluctuations. As a beginner, it seems very logical for you to get restless and kind of move, either buy and sell with the Nifty going up and down from time to time. But all of it is noise. In fact, Warren Buffett says it in a very nice way. He says that the stock market is nothing but a transfer of money from the impatient to the patient. I truly believe in it. Over the years, I've seen how people have kind of made less money than what they can make simply because of the restlessness that's there. So one good practice that you can have is to avoid short-term fluctuations, and that will help you build a better mutual fund portfolio.